Okay, so over on the board we basically have the two methods that are used in practice so far as apportionment is concerned, so that we can work our way through to getting like an applicable rate that we can use where we've got a general cost asset or a general use asset. So we spoke about the two methods that are used in practice, the one being the input-based method, and the one which is fairly quite popular in practice is basically called the turnover-based method, which is one which is we would likely be paying attention to. With the input-based method, we're just making you aware there is a method that's out there in practice. What would happen in this instance of the input-based method, you'd be supplied with inputs and you'd be expected to actually work out the applicable rate using those supplied inputs. However, it's hardly used in practice. It's not appropriate for our interest. The main interest that we should be paying more attention to is the turnover-based method. But just for an interest, the input-based method is basically based on a fraction as well, which would read as follows: VAT on supplies that are wholly attributable to taxable supplies divided by total VAT, and that would be the actual fraction for the input-based method. Whereas for the turnover-based method, we use a fraction as well, and it reads as follows. It goes to say that total value of taxable supplies, excluding VAT, divided by total value of all supplies, excluding VAT. And just remembering like the actual total value that we can actually look into when using the turnover-based method is that we must always retract from having to use values that would be capital in nature. They would not be appropriate for our calculation, and we'd also have to retract from using ICA values as well. So specifically what we basically aiming to use are those particular values that would be eminently so in our process of the business so far as transactions are concerned. So I hope that we on level path so far as that part. So turning our focus now to the example, which is the class example. It's been made to be I provided that within the slides, within the actual folders in terms of lecture 2. So if we can maybe read through that so that we tackle that question, and in order for us to have a basis and an idea of how to typically get through to a situation that would likely allow us to work out an applicable rate that we can go on to apply to a general cost or general use asset. So the question reads as follows. It says Poly Pty produces and supplies furniture equipment throughout South Africa, and additionally it has a separate service that provides their clients with an extended credit terms at additional fees of 5% being levied. The following information is applicable in relation to company records. They provide you with a bank statement, and the bank statement goes on to read opening balance, which is provided. Then it also speaks about receipts from debtors in terms of receipts from debtors for sales and receipts from debtors in terms of the interest portion. So in terms of that information, we're now aware that okay, this company is partly making taxable supplies because they're providing furniture equipment. They're also making exempt supplies in the sense that they're providing interest service to their clients as well as an additional service fee. And over and above that, we've been given some information, and we've gotten to understand that there's debtor sales, there's debtors receipts that we have been provided with, and we've also been provided with interest fees as well. It goes on to say to give us opening balances of debtor balances and interest balances as well. We've got both opening and closing balances. So that would be ample information for us to work towards the situation where we want to be in a position of getting an amount which is the earlier of receipt or payment, because we cannot just go into the payments balance that's been provided to us, because it would likely not be the earlier of receipt or payment. So for our interest, we basically need to be working towards a receipt that would likely be the earlier of receipt or payment. I hope that makes sense, because that basically requires us to work towards a situation that would be earlier of receipt or payment, and that's basically where we are. So just remembering as well that so far as statement balances, they do not contain VAT. VAT is actually exclusive. Besides, in a few unique cases, in a case where we're dealing with debtors, debtors and creditors are the only unique cases so far as statement of financial position, where debtors would likely not include, they would likely include VAT, the VAT portion. So let's be mindful of that, and let's rather maybe also work towards getting debtor balances and working out, like, the actual amount exclusive of VAT values, because this actual method forces us to actually have balances exclusive of VAT. So we provided you with that information. The next clip will be about the actual calculation part.